You're listening to Confessions of a Bookkeeper, where we look at businesses through the eyes of their books. My name is Mark, your Chief Bookkeeping Officer, and I spent years cleaning up and reviewing some, let's say, interesting books. In this episode, we're talking about something that every contingency-based law firm or litigation-heavy law firm experiences at some point: rollercoaster income. Not in the sense of chaos or disorganization, as these are very sharp firms, they know exactly what's happening when a big case resolves. But when many of those wins come at once, when a few seven-figure settlements land in the same quarter, it changes the rhythm of the year. Two personal injury law firms we work with recently experienced just this. Each closed several large cases within the first few months of the fiscal year. One had a $3.5 million settlement, another close to $4 million. Their firm's portions came in at around $1.3 to $1.4 million each. And then within weeks, another round hit. $600,000 of income here, $160,000 of income over there. That's a remarkable start of the year. These aren't the kind of clients who panic. They're experienced operators who immediately think, okay, that's a big year for net income. What does this mean for my distributions, for my taxes, for my cash flow planning? They're right to think that way. Those well-deserved wins have an added benefit. The timing of them gives them much more room and flexibility to plan. From a bookkeeping perspective, we usually see the first signs of it in the IOLTA reconciliations, those really big deposits coming in from insurance companies. And that's when the conversation starts. Because when the income hits in waves, it's not about bookkeeping anymore, it's about planning before the quarter closes, and that's where collaboration with your CPA matters the most. The value of current books isn't just in accuracy, it's in visibility. When your numbers are up to date, we can see the wave forming and start running different scenarios before tax deadlines arrive. Sometimes that means exploring new structures, creating another entity perhaps for investment or operations purposes, and we'll stand up the books from that from day one. Sometimes it means reviewing your overhead. If you're renting long-term and you've been consistently profitable, maybe it's time to evaluate owning your own space, taking advantage of Section 179 and 100% bonus depreciations while building equity. Or it might mean sitting down with your CPA early and accurately forecasting your quarterly payments. Because when you already know you're going to have a strong year, the smartest thing to do isn't to chase deductions, it's to fund the tax liability before it becomes a surprise. That's the kind of planning that's only possible when the bookkeeping keeps pace with your results. And that's where our work overlaps with your CPAs. They design the tax strategy, we build the financial structure that lets it actually happen cleanly. Now, when these particular wins came early in the fiscal year, it's quite ideal, obviously, with plenty of runway for strategy. But what if those cases wrapped up in November or December? That's a different kind of planning window. The income is still welcome, but the options are narrower. You can't exactly spend your way out of taxable income at that point. Law firms aren't capital heavy. There's no inventory machinery to offset profits with depreciation. So what do you do if you sense a major settlement coming? That sixth sense feeling every attorney has when they know a resolution can happen any week now. You prepare. And one of the simplest, most effective tools to prepare for that late year income is already available to most firms: retirement plan benefits. If you have a 401k or profit sharing plan, you can use it as a legitimate, tax-efficient way to manage timing. The key is that those plans, particular profit-sharing ones, need to be in place before year-end, and in many cases before September if you fully want to maximize them. When that big settlement hits in November, having those systems already set up lets you immediately make year-end contributions for partners, employees, and for yourself. It's not about avoiding taxes, it's about funding retirement and matching income to that purpose. It also creates natural withholding events that can absorb some of the tax impact without scrambling for artificial deductions. That's the kind of foresight that separates firms who react from firms who plan. The best run firms use bookkeeping like a radar. They don't need us to tell them whether they made money, they already know that. What they want is visibility, the ability to see how those wins affect our taxes, distributions, and liquidity months before the year ends. So as much as a bookkeeping service like ours serves as compliant accounting, it's ever so slightly different from strategic bookkeeping. One records history, and the other helps you plan for the future. When those large settlements hit, we're the first to see them, and that's when the real value of clean books show up. It's not about the transactions, it's about the timing of decisions. And when you're operating at the level most law firms are, that's the difference between a big gear and a smart one. Rollercoaster income isn't a bad thing, it's a proof of your success. But success comes with timing challenges that deserve some structure. Routine, ongoing bookkeeping turns those peaks and valleys into predictable patterns. Cash reserves build naturally, quarterly payments stay accurate, and tax season becomes more of a formality instead of an event. At Chief Bookkeeping Officer, that's what we focus on. Not just clean books, but systems that make momentum manageable. Because when income comes in waves, the smartest firms don't try to flatten the ride, they build a better track.